So it has been growing hugely over time. So about 60% of the active and passive is passive. So passive has overtaken active.
How does that change the market? Dimitri Vayanos is a professor of finance at the London School of Economics and co-authored a paper, Passive Investing and the Rise of Mega Firms.
Passive is a force that helps the largest firms in the index become even larger. When Tesla was added into the index, it had a capitalization of 400 billion. Over in 1 month and a half, it went to 600 billion.
Doesn't the market dictate what the price of a company is? Like, it might look overvalued, but if that's what everyone's willing to pay, isn't that just the price?
I'm a big fan of passive investing. I often talk about the fact that 90% of what I do is in a global index fund. But I think it'd be really useful for you to define to us what you think passive investing is as an academic, if that's okay.
Of course. So passive investing in its initial form was the idea that you're going to invest in a diversified portfolio and also a portfolio that involves no rebalancing, no retrading, in other words, or very little retrading. So for instance, you could buy the S&P 500 index in the US, the 500 largest stocks in the US, or the FTSE 100 in the UK. So you would own a fixed percentage of shares of each company and just keep it there. Don't trade it at all. This is how it started. And it has changed over time in various ways. Kind of more things now mean passive investing than they used to, but let's say in its kind of more common form is that.
Is this the argument behind it was that the majority of investors are not good at actively picking what they should invest in, and they should just track the market, and that the market is efficient in that sense, so it should produce a return in the long run?
Absolutely. That's exactly. It's an implication of efficient markets. So if markets are efficient and if investors price firms correctly, the optimal portfolio for every individual investor should be just to hold the market portfolio.
So like active investors, they try to beat the market and they think they can, like, they're smarter than everyone else, they can beat the market. But passive investors, we're just trying to track the market because we think the market is already efficient. So you're just kind of tracking the index.
Absolutely. And it cannot be possible that every active investor beats the market. So to put it kind of differently, the average investor should perform as well as the market.
Yeah.
And so maybe some active investors will do better than the market, but on average, passive investors will do pretty well, will do at least as well as the average active investor.
We know that even passive investors don't perform as well as the market because they trade in and out of the market. They become active in the passive strategies, don't they? They kind of dip in and out.
Active investors don't perform as well as the market.
And even the passive, if you look at the data around the return that a passive investor gets, they underperform the index that they buy, even once you've deducted fees, because they try and dip in and out.
I see, that's right. So exactly. So then passive investors try to become a bit active.
Yeah, they do market timing. The market. Yeah,
they're not truly passive. Like Morningstar did a report and they said, I think the average return over 10 years was 8.1%, but then investors got 7% because they all kept on changing, like trying to time the market correctly. So then they lose out on the returns because they fiddle with it when they should just leave it alone.
Exactly. And they have the bad habit of going in the market when the market does very well, which is generally when expected returns are low on the market, and going down when the market does poorly, which expected returns are high. So that's right. Of course, so there is even that element, kind of a market timing, poor market timing by investors doing passive. But of course, the worst is the performance of the average active, because the average active, as we said, they do more or less the same as the market, but in addition, they pay higher fees because they have to research the stocks, while passive is a much cheaper form of investing.
So we love passive, and passive is better than active, yeah?
On average, for the average investor.
Yeah. Okay. And what percentage of the market is passive?
Okay. So it has been growing hugely over time. So in the early 1990s, when I was starting as an academic, passive was like very, very small. It was about maybe, in 93, it was about 3% of active plus passive was passive. Everything else was, and the 7% remainder was active. And people slowly came to realize what we were just talking before, that just a pure passive strategy, kind of just holding the index, would do better than the average active, especially when we account for fees, for the fees of the active. And then this has grown a lot. And like in the end of 2023, about 60% of active and passive is passive. So passive has overtaken active. They overtook active about in 2020, and now it's about 60% of the combined.
So it's moved. I remember when it crossed 50% in
Yes.
about 2020, and you say it's gone another 10% in that time period.
It's about 60%, very close to 60% in the US.
Go on. And what I guess the question is, which is the topic of the research, how does that change the market? That rise in passive?
Okay, first of all, let me put it in general terms. First of all, there is this concern also by market participants, by especially regulators, like including the FCA in the UK. They are concerned that this can make markets less informationally efficient. Because the idea is that actives, despite their thing that what we're saying that they may underperform collectively, they do spend some resources in collecting information about individual stocks and they do price discovery in these stocks, price these stocks correctly. So if there are no active or very few active and a lot of passive, then the question is who is going to do the price discovery? So that's the general concern. And there is some evidence that the growth of passive has contributed in making stock price less efficient. Of course, still there is quite a bit of active. I mean, still active is maybe even 40% is quite a lot of active. But anyway, so that's the general concern, that the informational efficiency may suffer. Another concern, and I'm getting closer and closer to my research, another concern is that if passive is essentially the big indices, like the S&P 500, then the growth of passive will mean that money will go away from small stocks and into large stocks, and therefore large stocks are going to go up in price more. Because
of the capitalization-weighted nature of the index.
Yes, and because
the most popular indexes.
And because the indices are mainly centered into around large stocks. Like for example, the S&P 500 is the 5 largest stocks. Of course, there is also the Russell 2000 or the Russell 3000, but the more popular indices are the indices of the large.
S&P 500, even like a Vanguard's VWRL is large and mid-cap.
Exactly.
So, there is always a skew towards large businesses.
That's right. So the switch from active to passive can favor the large firms. That's another argument. Now, getting into my research itself, what we're showing, and we're showing this theoretically, but we also find empirical support for this in the data, is that there is indeed an effect that the growth of passive is kind of beneficial or makes the price of large stocks go up the most. And actually, this can happen even when the index, even theoretically, when the index includes all stocks. It's not just this pure kind of idea of there's a bias of indices towards large stocks, even when the indices are completely representative. So let me explain why. So to make it very, very simple, let's say that the growth of passive is just a pure switch from active into passive. So some active investors just stop being active and say, okay, I give up, I don't want to pay these costs, I want to invest into passive. So let's also assume that there is some, what we call noise traders. These are, for example, like some retail investors. Thank you very much.
What is a noise trader? A loud guy that's trading a lot, like
a noise trader is a guy who is trading a lot and who is trading maybe not in the way that maybe objectively could make good sense. So for some retail investors, for example, they say, okay, I want just to buy one firm because I'm very excited about that firm.
Because I like Elon Musk.
Exactly. I want to buy Tesla because I like Elon Musk and because he's cool and because the cars are cool. Not thinking that perhaps many other people may have had the same idea and maybe for that reason Tesla may be quite expensive.
They trade on noise.
They trade on, that's right. They trade on on noise, on something that may not be informative. It can just be noise. For example, I read this exciting thing about Elon Musk and I think he's very cool and I want to buy his company.
Vegan food is the future. Electric cars are the future. These are like examples, I think, like Beyond Burgers.
Absolutely.
Oh, Leonardo DiCaprio's bought Beyond Burgers, so I'm going to buy it.
Exactly.
And then it tanks.
That's right. Without thinking kind of about the bigger picture.
Business.
Yes. So let's say now that we have a big firm that has a fan base like that. Lots of retail investors are excited about it. And now let's say that there are some money that goes from active to passive. So these actives who are kind of, let's say, this kind of smart money, they understand some managers who are, let's say, they look at the fundamentals and they invest kind of in a sensible way. They underweight this firm that is kind of has this big kind of demand by the retail investors. Then when it goes into passive, the passives are going to hold according to the market weights. I mean, if this firm is a big firm and has a big market capitalization, they will just put a lot of money in it. So this will increase the demand for that firm. So let's say, again, let's stick with the Tesla example just for lack of a better one. So there is the price of Tesla is going to go up as there is this switch from active into passive. Now, Tesla is going to make a bigger and bigger part of the market. It's going to become a bigger and bigger part of the market. So now, for an active investor who is underweighting Tesla, who is not investing as much money in Tesla, or even staying completely out of Tesla, then it will become a bit tricky for them to keep doing that, because let's say they are evaluated relative to a benchmark, or either explicitly they have to have a tracking error, they have to track this benchmark quite closely, or they know that their clients are going to look at how they perform relative to the benchmark. So therefore they say, okay, now it's very risky for me to stay underweight Tesla, because if it keeps doing well, then I will look really bad. So therefore, they are going to reduce their underweight, or even a short seller might get concerned, say, now I have a big short position, now I have a lot of risk. So therefore, they will buy themselves, even those people who were originally not holding much of it. And therefore, this will push this price further up, and can get us into this spiral, more demand by the switch from active into passive. This causes these stocks to go, large overvalued stocks to go up, and can create more demand for these stocks, can cause them to go further up. So this will not happen for a small stock as much, because small stocks are not a big part of the market. People don't, even an active investor, if they don't hold much of a small stock, they don't really care so much if they think that it's overvalued, because it doesn't. A small stock is peanuts. It doesn't make much of a difference in their return.
Do you see then, when a company enters an index, that it suddenly increases in price?
Absolutely, it does.
Is that like proven?
It's proven, of course. It's called. This is a famous effect in academic finance. It's called the index addition effect. So people have noticed this since the mid '80s. I mean, it's a bit tricky sometimes to see. We don't see it on the day of when it's added, or when it's announced it's added, because now people even try to forecast when it's going to be added, and then the price anticipate that even, I don't know, a month earlier or 2 months earlier. The cool thing is that this index addition effect, is strongest for the largest stocks. So, for example, when Tesla, my favorite company, when Tesla was added into the index, it had a capitalization into the S&P 500. It had a capitalization of 400 billion. In 1 month and a half, it went to 600 billion. So partially because the market was surprised, we did not expect at the time. Anyway, so in any case, for the largest firms, when we have shown this in the data, the index addition effect is huge.
Do you know MicroStrategy? Michael Saylor's Bitcoin fund. You know, MicroStrategy was it was like a software business for years, but now he's basically turned it into a Bitcoin buying business, hasn't he? And I know that at points he knocks on the door of being able to be in the S&P 500. Oh, yeah. Do you think there's a responsibility from the index provider to have like a checklist around these businesses, or are we then just destroying the passive to be an active fund? In the sense of, the S&P 500 especially, they won't just go off market's capitalization, will they? They won't just go, the business is this big, it's in. They want to look at like sustainability of profits and these other points.
Yes, exactly. It's not a mechanical index, as far as I understand the S&P 500. They do look at the earnings. For example, it took them some time to add, for example, Tesla. They wanted that it was not just about market cap. It also had to have its fundamentals had to be above some criteria. Mm-hmm. So this is why it was added when it was already quite big.
And do you think that's a safeguard against what you're talking about these companies coming in that really shouldn't be there?
Yes, exactly. At least for some industries. Now, some more industries are more mechanical. It's not that, certainly the S&P 500, which is the most important one. Yeah, there's a bunch of criteria. Which I think can act as a safeguard that you mentioned.
So T. Recently, we had a conversation with tax expert Dan Needle, and I think one thing that became very apparent is you're going to have a real big crypto tax bill.
I am.
What are you going to do with the money, mate? Where are you going to put it?
I don't know. Like every year tax season comes around and I'm stressing. I'm like, how much is my bill going to be?
I'll tell you how I do it. What's important for me is that money, that tax money, is completely separate to every other bit of money in my life, because otherwise I start counting it as mine. I start locking it away in the stock market or whatever. So I use a tied instant saver account. That's just attached to my business, and I just put the money in there and keep it in there, and that's solely for the tax.
You can just ping over to taxman when it's tax time.
I just know it's allocated for, and the stress that takes off me is worth its weight in gold.
Every January I'm stressing.
Check that out, mate. We've got a bit here actually about how you can check it out yourselves. I'll let you read it out because, you know, you're the best at reading.
I mean, I'm the star reader of the show. If you're a sole trader or company owner, check out Tide. New members can get up to 4.22% AER variable for 6 months. I say up to because it depends on how much you deposit in your account. The more you save, the higher the rate.
You can get this deal, plus you can get £100 cash back if you fund your Tide Instant Saver account with £5,000 in the first 30 days. You get that by using the code MAKINGMONEY. Terms and conditions apply. The code is Making Money, all one word, and you'll find the full terms and conditions and all details of the offer in the description below. The variable rate is correct as of the 19th of June, 2025. Okay, and one argument would be that if there is more indexing, surely the amount of noise traders reduces in the market.
Yeah, that's a very interesting argument, exactly. So, because the argument that I just made before is about a switch from active to passive, but I somehow said, okay, there is also these retail investors who are sitting there and they're kind of causing markets to be mispriced. So, of course, if the retail investors as well, who are kind of some retail investors, the ones that are kind of are following this kind of noise trader kind of signals, we're also going to switch into passive, and then some of these kind of effects, some of this mispricing and distortions could become smaller. So then passive could be a force for good, kind of more than what we saw in our paper. Now, the interesting part is that it seems that the switch from active to passive comes mainly from institutional investors.
From the active investors?
From the active investors, but from the active institution,
not retail investors.
Not as much retail investors who are following active strategies.
So it's not our fault, it's the institutions. Are they pretending to be active, but they're actually passive?
No. Sorry, let me just clarify. So there could be some retail investors who are buying active funds.
Yes.
And there can also be some institutional investors who are buying active funds. For example, like, I don't know, a pension fund, for example, is investing actively, or a sovereign wealth fund is investing actively. Now, the retail investors could buy ETFs, or the pension fund could buy an ETF. Okay, so typically, what happened? I mean, both classes of investors, both the retail and the institutional, have moved on average more into passive. However, the institutional have been doing much more of that. So the retail, typically, what they do, many of the retail investors, they go from one active that kind of falls out of fashion to actives that are kind of more in fashion now. For example, they used to do more ESG in the past, and now they do more of AI, big data funds.
Yeah, it's because. Like one of the things when I was reading your paper and I was thinking about it, it's almost this implied that the active guys are somehow smarter. So if you put your money with them, they'll guide it. But I think most retail investors are pretty dumb when it comes to picking their active fund managers. We see this with like Cathie Wood, right? We know that most of the inflows happen after they've had strong performance.
Yes.
And the retail investors just chase around the hot fund manager at the time. And I question if that's good for them. You know, they at least with passive, if they stick to passive, you know they're going to get a return. Whereas as soon as you start to say, oh no, we need this active component funded by, say, retail, they just chase them around. It's the same thing again. They're noise traders within the active space.
Correct, absolutely. So I guess, yeah, so we're trying to make a distinction between maybe some investors, who maybe invest in a very inefficient way, and maybe based on this, as we said, these noise signals, and maybe some. Okay, so there are some of those. There may be some other investors who are a bit savvier in how they invest, and they do still invest active. And so we're somehow assuming that the first class of investors, these kind of more dumb kind of investors, they don't switch as much into passive. It's more like the second class of investors who switch more into passive.
Okay, yeah. So you're seeing like a brain drain almost into the passive side.
Which is consistent with this evidence that I described before, that the switch into passive comes more from institutions, from like the pension funds and the sovereign wealth funds, and less from the retail sector.
People who have an argument that they should be more active. But at the same time, fees are the one thing that's certain, right, for an investor. And I think most pension funds have this kind of obligation or duty to maximize returns for their investors. And the only certain way that they could do that is by reducing fees. And if they could shave those from 2% to 0.2% over a 30, 40-year timeline, that's going to double, treble the portfolio potentially. So I can see, like the argument to passive for these from their mandate is strong, right? Because the evidence of them being active is weak, in terms of performance.
Yeah, exactly. I guess, eventually, if there's so much of a switch into passive, then the returns from active are going from whatever smart active are going to be higher and to compensate for this extra cost. Maybe we're not yet at that point.
Because the market will become inefficient. So the active guys will be able to make loads of money because there'll just be opportunities lying all over the place.
Exactly.
Whereas at the minute, the American market is really hard to be active in because it's so well documented and pored over.
One could argue that maybe there are some opportunities there as well, and part of the thing has to do with short-term versus long-term investing. That maybe if you were to do like some kind of really fundamentals-based investing, and you were able to have a very long horizon in your investing, then maybe you could even some of these institutional investors could. Maybe take a more active view, but because they have to stick close to their benchmarks, maybe it's they don't want kind of being active and kind of taking some views is risky for them in the short term.
I think this is a great point. So the fund manager incentive is to not underperform the index too badly because they just will never, their inflows will dry up. So they have this incentive to kind of herd around the index. So they end up just tracking the index as well, in a way.
Absolutely, exactly. 60% of all mutual funds and ETFs are passive. This is about 18% of the US stock market, but there are many other investors who are classified as active formally, who are doing something that is very close to passive. Essentially is what you were just saying before. And the people have tried to measure that in academia. They have been, for example, by looking at how much volume there is, how much buying there is when a stock is added to the index. And they have, by extrapolating that they have found that it's about twice as much the true passive. Not only people who are passive and declare they are passive, funds that declare they are passive or ETFs, but also actives who are doing something that's very close to passive.
But is it always close to passive, or are they sometimes pretending to be a bit more passive to kind of attract retail investors?
Well, I don't think they want to be pretending that because they are charging these higher fees.
Yeah.
So if they are saying that we're passive, the investors say we should go to the true passive. I think it's more like this what is called closet indexing, that somehow they are doing that while saying that they are active.
Closet indexing.
That sounds naughty, doesn't
funny.
it?
That is funny. They're in the closet about the fact that they're really an index. I think, but if you're an active fund manager and you're thinking, I need to make a return, and I know that any investment, any company that gets added to the S&P 500 statistically is going to increase in value, it's a sensible thing to do to buy it, right? And then it almost becomes a self-fulfilling prophecy because they're pouring money in.
To buy it before it gets the price bump.
Yes.
This is why people are trying to forecast with very sophisticated models which company is the next company that is likely to be added. And this is why people now, when they look for this index addition effect, kind of this bump, they find that it has gone down quite a lot. And the reason it has gone down a lot is because it's anticipated quite far in advance.
The market being efficient and
yes.
Seeing the future.
Yeah.
So one thing that was really interesting to me when I was reading the paper, or something that I was thinking about was, I don't know if you even know this, but if we adjust for inflation over time, has passive investing increased the size of the market overall? Is the market bigger as a result of passive investing versus active? I guess, are there more participants in the market now? Is there more money in the market now since this rise in passive?
That's a very good question. And I think that passive investing very likely has widened market participation just because it made it cheaper for people to enter in the market. One place to see that is to look at the flows into passive. About maybe 80% or so come from people switching from active into passive, but about 20% is just new investors.
So 80% of the flows into passive are people abandoning the active strategy?
Roughly 70, 80%.
So they are hemorrhaging money into these. It's not that like passive is rising and they're just bleeding out essentially into the passive market.
Yeah, but still, getting 20 or 30% new investors.
Yeah, it's great.
It's.
But this then increases the amount of noise because those investors will be inexperienced retail investors.
Correct. That's right. And this is why some people have said that argue that maybe there is more inefficiency into these indices, maybe because you just get these retail investors into the market, and maybe sometimes the market may move kind of too wildly relative to the fundamental, just because you get all these people who are inexperienced, as you said, and are trading this passive.
Yeah, because most people that come in passive, they always try and buy a few businesses on the side. You know, they go, oh, I'm going to buy the S&P 500, then I'm going to buy Apple, Microsoft, and this, and they buy the S&P twice, basically.
Exactly, and they do that, and they do what you said earlier, that they do this, they get in and out of the market itself.
Yeah. Okay. And so another thing that was in my mind when I was going through your research, this idea of, you know, volatility, and these big businesses, they just kind of, they hoover up assets under management. I know that from research that the amount of time companies spend in leading indexes is reduced. So I've got the data here. So in 1965, companies remained in the S&P 500 for an average of 33 years. In 1990, it fell to 20 years. And the projection is that by 2026, companies will spend 14 years in the index. So they're falling out of the index quicker. How would your research explain that?
Well, actually, I'm not sure that we have something to say about that. I mean, certainly we have, what we can say is that passive is a force that helps the largest firms in the index become even larger. So I think...
Do you think the top end will stay there and the other guys?
Yeah, at least it creates a bias for the top end to stay there. Mm-hmm. I think if the time stayed in the index has gone down, it's probably because the economy has is going through a period of structural change, and the kind of sectors that are growing.
Interesting. Tech has risen since maybe 2008. Tech dominance because the dot-com bubble, and there was that period where probably the load fell out of that index then.
Yes.
You highlight within the research that one of the ways that it helps cement these big companies is through their ability to raise finance for cheaper. Yes. Can you explain that impact and how that works?
Of course. So the higher is the stock price of a company, the cheaper it becomes for the company to raise capital, because it can raise a company can raise capital by borrowing, and maybe the cost of its borrowing, the interest rate it has to pay on its bonds, maybe does not go down, but it also can raise capital by issuing new shares. And if something happens and the company's share price is goes up a lot, just because of the price pressure caused by this switch from active to passive, the company, if it wants to raise a fixed amount of money, a fixed sum, it can raise it by issuing fewer shares. So it becomes cheaper for the company it does not dilute its shareholders as much.
So a little quiz for you. Do you know what any of these things mean? ISO 27001, SOC 2, the EU AI Act, or DORA? If not, no worries, but if you do, it probably means you work for a company that cares about security and compliance. If you're a growing business today, you have to prove that you comply with security and privacy frameworks like these, and GDPR, so that you can land big deals and grow your business. But the problem is, achieving and then maintaining compliance with these frameworks is time-consuming and complicated. This is where our partner Vanta can help your business. Vanta automates up to 90% of the work and 85% of the associated costs for in-demand frameworks. So if you want to prove that you're secure and compliant, check out Vanta. You can also get $1,000 off Vanta if you go to vanta.com/making money. So that's vanta.com/making money for $1,000 off, and there's a link in the description for you. Especially if they feel that they're overvalued internally, they'd be like, well, we might as well issue new shares, because, I mean, an extreme example of that was GameStop, right? When the price went up crazy, they just started dumping shares on retail investors because they were like, well, we can turn what we think is an inflated share price into actual dollars in our bank account.
Absolutely. That's a very good example. And this happens every time that there is some kind of high valuation of firms. I mean, every time. I mean, on average, firms invest more. And sometimes this investment, if it's really overvaluation, this investment can be wasteful.
Overvaluation is an interesting thing. I highlighted it within the introduction, you say, we study how passive investing affects asset prices. Flows into passive funds raise disproportionately the stock price of the economy's largest firms, especially those firms that the market overvalues. And the question I wanted to ask was, how do you know that they're overvalued?
Well, okay, so one thing is kind of theoretically, we can kind of say, okay, here's we build this kind of replica of the world, this model of the world, and within our model, I mean, essentially within the model, the overvalued firms are the firms that have a lot of these noise traders, these kind of people who are, for some reason, very excited about the firm. Of course, the question, I think the question that you're asking is how can we see in the data, how can we, or in the real world, that the company is overvalued? And that's a much harder question. And I don't think that is a question that people should spend too much time.
I don't know that anyone can convincingly say if a company's overvalued or not. Maybe Warren Buffett's got an argument that he's pretty good at it, but it's a very hard thing, isn't it? Because value is subjective.
Yes. So of course, yes. I mean, of course, there are signals, and there are various what we call in academia anomalies, trading anomalies, and trading strategies that somehow use some notion of overvaluation. For example, there's a very famous kind of anomaly in trading strategies which is called the value strategy, and there you look at some measures of let's say the company's market, the value of the company's market, the company's market value relative to some kind of accounting measures of the company, like earnings or the book value of the company. Now, much of this kind of variation of that ratio, kind of why company's market value can be much higher than its accounting value, is driven by fundamentals. But some of it, some part of it, maybe 20% or so, 10%, can be driven by overvaluation. So academics have measures for these things. It's not a slam dunk. It's not that always when the measure says that the company is overvalued, it is overvalued. And it's also not the case that when this measure is high, that you can short sell the company and make money the next day. It can be more like a long run, from a long run perspective. But there are some metrics that are informative, at least are correlated with overvaluation.
Well, as markets are quite advanced nowadays, they're quite smart. Isn't everything pretty much priced in? Like Trump does something with tariffs and it's kind of priced in already. So Tesla was like, people said it was overvalued because they made like a fraction of the amount of cars as Ford did. But everyone wants to buy Tesla because they're like, oh, it's the future, electric cars, robots and stuff. So doesn't the market dictate what the price of a company is? Like it might look overvalued, but if that's what everyone's willing to pay, isn't that just the price? Like if I sell Damien my chain for like $2,000 and he buys it, that's the price. Someone else might be like,
$2,000 then.
Well, it's worth $2,000. But yeah, but like someone could say that's overvalued, but whatever someone's willing to pay, isn't that the value of and the whole market said Tesla should be worth this much. Is it really overvalued, or is that the price that we've decided?
That's interesting. Okay, so I guess another way to ask the question is more like about whether future returns are predictable. In other words, indeed, maybe people are willing to trade the company at this particular price, and that's the price, as you said. But maybe there are some signals about a company, including the price, that can statistically predict the future returns of the company, maybe not over the next month, but maybe over the next, year or the next few years. And so if we can predict these returns, then there might be some kind of mispricing in the market. Now, a big part of research in academia is about seeing whether these returns can be predictable. And not only that, but also whether this predictability of returns reflects some real risk of the companies that investors kind of are rationally compensated for, or whether it reflects kind of some kind of misvaluation. What I would grant you is that markets are efficient to a significant extent. It's not that mispricing is kind of obvious and blatant, but if one looks at the data kind of in various ways, there can be some signals.
But at the same time, you can have all of this data and make your prediction, and then Elon Musk does something like a Nazi salute, and then the price of Tesla crashes. So I think like 20 years ago, this wasn't quite such a big problem because the world wasn't so connected. We didn't have news and social media. But now a whole company's stock price can change just because of one person's tweet or one person's action. So even if you do all your data and then Elon wakes up, he's like, today I'm decide that like I'm a Nazi, then
gotta change the model.
Yeah, the whole model's just screwed because of one or Donald Trump tweets something, the whole model changes just because of tariffs or this. So is any prediction really like reliable in this days and age when everything changes so quickly?
Look, of course, I mean, every prediction has noise, and every kind of always things can happen that are unanticipated and random. And this way, I emphasize that some of these signals are kind of very much for a long-term perspective.
Yeah.
So what do you think the outcome is of these large companies in the index? What is that doing to the market? And what's the risk to passive investors?
I think if you ask me about from the viewpoint of a retail investor, I would say that going passive instead of investing in a kind of a small and undiversified portfolio, I think would be a good thing to do.
That's a relief.
Yes.
Wealth is in that strategy. And yeah. So that's nice. We can end it there.
Job done. Thank you for coming on the podcast. Appreciate you.
I think I mean, it's good. I would like to put things in perspective.
Approach?
I think it's a sensible approach. I mean, I would for sure not tell a retail investor to hold, like 3 or 5 stocks. I would say, or even to put a lot of money into active funds. I would say that it's better to hold a low-cost passive fund. And this is if you ask me what I'm doing, I'm kind of most of my investment is into kind of low-cost passive funds. The point that we're making in our research is that kind of this big switch from active into passive, which is happening for a good reason, for a reason that passive is, what we discussed, is cheaper and everything, can cause markets to become more distorted because there are fewer of these active people who are going to kind of, do the price discovery, collect the information and correct kind of mispricings. But if perhaps, if someone was, if I were advising, talking to a sovereign wealth fund or to a large pension fund, I would say, yes, maybe you should think more about putting some money into active and let's discuss kind of what active kind of you should do. But if I were talking to a retail investor, I would say that no, you don't have time to do that. Just you should focus on simple passive investments.
It's funny that the thing that was designed to save the retail investors is being spoilt by the active guys. Is this not like a thing that the active market is always going to say? It's kind of, that thing you're doing over there that's saving you loads of fees that we used to collect, that's really bad for you. It's going to break the market. It's kind of like, we've had a lot of people there that are active fans that have said that kind of thing. And yet every year passive beats them,
Yeah. I mean, I guess it's true that the active investors may have this, may find this argument kind of plausible and appealing, rather. But at the same time, I mean, there is something to be said. That I mean, the more passive there is, as we said before, the more kind of attractive it becomes to be active. Eventually, if everybody goes passive, kind of it would be big returns to be active. And also, the other thing to notice is that let's say, for example, that money goes from a lot of money goes from active into passive. So what's going to happen? So from the point, let's say that we think of the point of view of an active manager who invests kind of in a very kind of a long-term fundamentals kind of way. And this person identifies these companies that are, for some reason, they are overlooked by the market, they are undervalued. Now, if money goes from active into passive, what's going to happen? Then this active investor and a few others who are holding these companies are going to lose funds, and they're going to passive. So these companies are going to become even cheaper. And these kind of sophisticated active investors are going to have low returns. And they will see that the kind of companies that they think that are kind of cheap become even cheaper. So they would say, we see that kind of the market becomes more mispriced, and our job, which is to correct these mispricings, is going to become even harder now because we are losing all this money. Maybe for a new active investor who comes in fresh, they will see bigger opportunities. But for these people who have already these positions, they will lose money in the transition period. Yeah,
I mean, I've heard people say the UK market is cheap for a long, long time, and it just continues to remain cheap, and it's like they're just dying on that hill, Whereas, and I've heard people say the American market is expensive, the Schiller Cape and all of this, and they hold up all these stats, and then year after year, it's like if you've sat out of that market, you've lost big in that sense. So, yeah.
What do you think about the passive people who aren't so passive. So for example, they might invest in like 6 different passive funds. So like they might have like a S&P 500, then a world fund, like a global fund, a global index tracker. Then they might have AI passive fund. Like,
Is this your portfolio?
this guy knows me well. Do you think that they still, and they make changes, do you think they still count as passive, or are they kind of passive active?
That's interesting. That's a bit of a gray area in some sense, because first of all, there are some some funds that kind of say that they're passive, which follow an index that is defined with some not very kind of somewhat vague criteria. So they say, for example, a manager can say, I'm a passive fund, I follow an AI index. What is this AI index? Okay, I define where the AI index is, and I will kind of put whatever stocks I think that belong there. Okay, so that looks very much like active. By the same logic, kind of an investor who moves across different active funds, let's say, for example, between, let's say, this kind of plain, let's say the S&P 500, let's say a global index, a European index, an Asian index, and then moves across those, also is doing an active asset allocation. So, I would classify this as active. Maybe not the active of in the style of holding, I don't know, 5 stocks.
Yeah, but they're still active and they're making decisions and they're changing things.
Yes.
What do you think the ultimate threat is if we continue down this route of, say, like, just as a thought experiment, everyone can probably see my little leg now. Right?
Damien's strong calves poking out.
You lucky sort says that's my knee. People be like, he's got legs, because they never see my legs; they only see from the waist up. Anyway, sorry. Let's say the market became 100% passive. What would that do to the market, do you think?
Well, what it would do is that I think there would be much more volatility. If, let's say, for some reason, for any reason, someone who held a big, let's say, some stake in one company had to get out of the company, there would be nobody who would be able to take the other side of that trade. Passive funds would have to buy the portfolio of all the companies together. So then we would see, for individual stocks, we would see much more volatility and more mispricing, essentially bigger deviations between prices and their fundamental value, whatever that is.
Why would we see more volatility? Wouldn't we just see the S&P 500 on the day that the market became 100% would just stay as is forever? Because it'd be like, well, 5% forever goes to Apple now. And do you know what I mean?
You mean, okay, so you're saying, okay, I'm just trying to conceptualize this situation. So you're saying that everybody would be active.
No, everyone passive. There'd be no price discovery anymore, right?
Everybody would, everybody
we just have a wall of money flowing into the index as is.
I see. So, every company would be held. All its shares, 100% of its shares would be held by passive.
Yeah.
I guess. Okay, fine. Fine. Maybe this is a bit hard to conceptualize for me because still some shares have to be held by the employees or by the managers or by some controlling shareholders. But in any case, so I don't think we can get.
It's impossible to get.
It's impossible. But theoretically, okay, let's think of it theoretically. It's interesting still to think through it. So if this could happen, then okay, so prices would be completely uninformative because who is going to follow the companies and kind of see if, for example, the company has exciting future prospects? How is this going to be reflected into the price? Effectively, nobody would be trading these companies.
Yeah. So they would just, on the day that it happened, we would never move from that. Every company would just stay right where it is. Basically.
Exactly. There would be nothing that would make things move.
Okay. So is there a point percentage-wise where you think passive becomes a danger to that? Obviously, 100% is impossible, but at 80% passive, which we could get to if we're seeing these, we've grown 10% in 5 years, which is crazy, right? Is there a point where the market becomes too passive?
Yeah, it's a bit hard for me to venture into this guess, but I would say that 70% passive probably should still be okay. Above that, I would have to. I think certainly 90. I think would be too much.
But realistically, do you think we could reach 70-80% passive? Because human nature, like passive investing, isn't really. It's kind of counterintuitive. Everyone's like, I'm smarter than everyone else. I can beat the market. So for 80% of people to be like, I'm just going to leave it alone. That's not really very realistic with human nature. Just being like, oh, I see an opportunity. I can beat the market. I can pick this. I'm smarter than everyone else. I
think that, look, I mean, we have reached 60%. I think that you're right. I take your point about that kind of is human nature to invest in active. I don't know, but yeah, at the same time, we have seen kind of a lot of investing becomes more institutional. Kind of people invest more now through their pension funds. Pension funds kind of give them, and for good reason, they give them choices of kind of well-diversified portfolios. So I think we would see more growth. I think we can. I would see this kind of going to 70%. I could see that going.
Yes, I mean it's the wall of money, and also as well, I would say that generationally, my parents are more likely to be active because they have this belief that there's people out there that are smarter than the market. But whereas my generation are more likely to be passive, and there's probably going to be a large amount of flows down to millennials and maybe younger through inheritances. So you might see a wall of money there shift, because if I inherit their St. James's Place portfolio, I'm going to be like, well, I'll rip that out and put it into a Vanguard fund, you know, and so you might see those kind of shifts as well through the generations.
Yeah, I think so. Yeah, so to recap, I think that we'll probably see more growth of passive, and of course there will be the incentives for eventually for kind of. There will be more profitability for active investors, and there will be some equilibrium where there will be some maybe a bit more passive than we have now, and the rest will be active, and some of this active will be real active, kind of sophisticated active.
If rather than from just the investor side of things, then can we look at maybe a little bit more broader economy? If these big firms find it easier to raise money and they kind of have this like pedestal position, does that make competing with them harder? Does it make innovation harder?
Yes, it does. I mean, I think this is an issue, at least if one were to take our findings seriously, that this would give the growth of passive indeed can give an advantage to the largest firms in the economy, which could potentially lead to these effects that you're mentioning. So I think we have to think about ways that we can I don't know, smaller firms can also raise capital. That's important. Maybe that if they're not in those indices, or if they are not,
So do you think that a large part of the rise in the big tech businesses is because of the rise of passive, not just because these businesses have reshaped the world?
Yeah, some part of it. We find that what we find in the paper is that if a firm was in the S&P 500 for the past 25 years or so, then it would have risen by 30% more than the market because of this effect of passive. So that's a bit of an upper bound. I mean, I think the tech firms, they have grown more than 30%. Mm-hmm. So, but anyway, the passive has contributed to that extent. Of course, and it's a big if. I said if a firm goes in the past 25 years, because as you said, there is a lot of turnover.
So index funds, relatively new. Indexes, not new. There's always been like the index, the list to track. Has there not always been concentration within indexes? I know General Motors was a pretty big part of the index, right? Are we just worried about something that's always been a trend?
Yeah, that's a very, very good question. Of course, I mean, index concentration can happen for many things. I mean, we're just obviously we're not saying that the passive is the only reason that is driving index concentration. It could be because of trends in the economy. Sometimes sectors become larger just because there is some change in the kind of some innovation some technological innovation in the economy. So, or sometimes some companies are like monopolies, big monopolies, like they used to be the case in the US.
Rail industry was massive, right? 70% of the US market, I think, was rail.
Exactly. So, the only thing that we're saying is that passive has been contributing to that recently. So, I mean, what we look in the data, we say, okay, during quarters or 3-month periods when there are flows into passive are much larger than their trend. During those quarters, the largest firm in the index do significantly better than the rest of the index, the S&P 500. So there seems to be an association. It's not the only driver.
Do you think the country could do the same? So America at the minute, at the time of recording, who knows what's going on, but there's turmoil there and people are doubting America as a brand almost, but the markets recover quite quickly. Do you think this wall of money just going 65% into the American market every month could be supporting them in that sense as well? So it's not just the big companies, it's the big economy, and they have this dominant position that then becomes hard to slip from because everyone passively just pours money into their market.
I don't know. I think it's a bit early to tell with all these changes that are happening these days. But it's very uncertain. I mean, it's if you ask me whether America is going to remain dominant, I think that now I don't know. If 6 months ago I would say obviously, but now I think it's much more uncertain, and the same applies for the dollar and everything. It's a big discussion, but
it might be the cure to the passive, because people might be like, hold on a second, American exceptionalism now is not what I thought it was. My index is 65%, so I'm gonna pick up a world ex USA to dial down a bit or whatever.
Yeah, I mean, I guess maybe you have in mind like a global index that is.
That's what I buy. I buy a global index, but
yeah.
I can concede that I'm basically in the American market with a little bit of like entrees on the side.
So weighted heavily to America.
65p in every pound, and then if you go a layer deeper, like 20p in every pound is going to 5 or 10 companies.
That's right, exactly. So yeah, it's possible there will be this reallocation that I think, and there has been such reallocation that we were talking about before between let's say within passive funds, but across geographical areas.
So maybe that will help.
That will
It'd be interesting if you study this in 10 years and you go, oh well, that moment there,
yes,
money started to move more actively because of the doubt around America. My personal view is I just keep buying the index and
the global one.
Yeah, it's always a global index. Yeah, I mean, I know it's America light, right? But I think you capture the global trend, because I know that, if I look back over, say, 100 years, there's been times of American underperformance, and typically the world outperforms America in those periods. Lost decades like 2000 to 2008, after the dot-com bubble. So yeah, that's why I buy globally. I think if you're buying a global index, you are backing America. And I'm not betting against America. I'm just willing to take a couple of percentage points potentially shave, which I have done as a result of buying globally, for the idea that I can sleep at night thinking, well, I've got a bit of everything. And if that goes wrong, well, we're all screwed anyway,
No, I think it's a perfectly fine strategy, and this I think is in the spirit of what I was saying before as well. That I think it's for retail investors. I think it makes perfect sense to be well diversified through a passive.
Are you optimistic about the direction of travel for the markets, or do you think that this paper is a warning to the world that we need to do something different?
Okay. That's a good question. Let me think a little bit about this. Okay. I will say about my view about whether this paper is a warning. Yeah, what this paper says is that we think that kind of the growth of passive is a good thing. This is what we think, because it's kind of a cheaper way to invest, and kind of is good for individual investors. It can kind of also make kind of it's based on market efficiency. We say that it's not always a good thing. I mean, I said if if the growth of passive means that still we can have many investors who kind of do this kind of random things, kind of these noise traders, maybe markets can become more inefficient. So the growth of passive can be a good thing if there is also more sophistication in general, even by the investor community as a whole. So sometimes there can be conditions under which the growth of passive can result in less efficient markets. I guess this is what this paper says.
Yeah. And is there anything that, I know you've been cautious to not focus on the individual too much, and I think one of the best things out of the research was this realization that there's a lot of the issues are active that are pretending to be passive and stuff. But do you have any takeaways from the research for the individual? Anything that you think, this is what you should take from this? Maybe it's reassurance about their style of investing, or anything that you think that they should do?
Okay. So again, I should preface it by, as I have emphasized, that passive can be a sensible way to invest for individuals. So now, the research says, that there can be a bias in the market that can cause maybe some of the largest firms to become to become artificially kind of their prices to be pushed up more. So I would say perhaps if in the spirit of this allocation of money that is kind of close to passive, but it's not exactly passive by individuals, maybe that one could maybe emphasize a bit more with a long horizon perspective, of course, in maybe, I don't know, not as much the largest firms in the economy. Maybe have some indices that are, I don't know, like sometimes medium-sized indices or something. But as long as one still kind of keeps a good diversification. And so maybe this would be an implication. But I would certainly not tell an individual investor to go out and short large firms.
No, but have some exposure to the smaller companies in the world if you can. I know the FTSE 250 traditionally does better than the 100, because these are smaller, faster growing businesses. And I think maybe there's an inclination to that. And I do think a lot of investors buy the index and then they go and buy the 5 biggest businesses on the planet and they think that they're investing, whereas actually they're just parking a lot of chips on these big companies.
Exactly. So I would tell them not to do that.
Yeah. Not investment advice.
Yeah, not investment advice, don't do that. That was pretty cool. What do you think about Dimitri, Damon?
Thought he was a good guy, stand-up guy. I like the academics.
How did it make you feel about your passive investing philosophy?
Honestly, it kind of made me feel even more better. Yeah, but it made me feel good about it because what I took from that was, obviously he said multiple times he still thinks for the average investor it's a good outcome. But more importantly, the real issue is the fact that the active guys are going passive because they know,
they know it's a way.
Yeah. So, yeah, I felt pretty good about it. There was nothing in there that made me think, oh God, the world's going to end.
Unless everyone turns passive.
Yeah, but even he was like, what are you asking me? 100% passive? He said it's pretty much impossible. We just need that price discovery, don't we? Who knows? I think hopefully it's decades away before we have to think about it. We actually put together a free investing in index funds for beginners course as well, which we'll link below and here, if we can link it here. Which I think is a great place for people to start if they want to get involved in that kind of thing and the investment approach that I follow. It's not investment advice.
Never.
Nope.